Hi everyone, my name is Piterpakulski. Today I would like to show you the final version of financial model of a truck. I will be going through all the inputs. I will try to show you what is important when you would like to start this type of business. I will go through the inputs from top to the bottom of this model. Also, I will give in the description of this video the links on the videos telling you the way how I've created this financial model from scratch, video by video, block by block, revenues, direct costs, fixed costs, investment plan, and so on, cash flow statement, financing, and so on. So all links you will be able to see in the description of this video. If you find this video valuable, you may give us a like, subscribe our channel, share this video with your friends. Also, you can order a financial model from scratch for your unique business idea. We can help you with that. So let's go from top to the bottom of this model, and I will show you the specific features of this model and of this business. So the first rule is all inputs in our financial model is colored with this color. They are blue, like this, like this, like this. I've hidden all the calculations, so now you can see only the inputs. Our model is organized. The first block is inputs. The second spreadsheet is a simple table for revenues, expenses, profitability. So just simple numbers. What is the outcome of the model? So revenue, expenses, profitability. Just everything that you need to know about your business. All you have to need to know about the business. So here you can see simple and discounted payback periods diagrams. So the moment when this diagram crosses the timeline means that it is the moment of a payback of our investments, of our money that we invested in the project. This is the simple payback period. This is discounted payback period. In this spreadsheet we set up the discount rate, and we set up the step of changing adjustment of discount rate to figure out the internal rate of return more accurately. Here in this spreadsheet we have a sensitivity analysis where we adjust the step of changing of this or that parameter of revenues or expenses, and here we will be able to see what are financial efficiency parameters of this or that scenario. And what we're starting with. So first of all, we assume that our truck that we bought, we have different pricing for different so for example, we have some mileage during we've done some mileage during the typical month, and we have different pricing for different mileage. And let's say that, for example, 30% of mileage done by this month, 30% of mileage is priced by $12 per month. It is the revenue parameter. 10% of mileage done is priced by $9 per mile. 50%, for example, of mileage is priced by 6, and for example 3% of mileage is priced by 0. So this also can be a 0 here. So here we specify the pricing per mile. Here we specify the percentage of monthly mileage that we make. Also, we've created some coefficients to price. For example, when we build the cash flow statement and see the payback period, we would like to play with inputs, quickly create scenarios. For example, what we can do when we want to create some scenarios. For example, we have $12 per month per mile, and let's assume that we are too optimistic with this value, and we would like to see, for example, if we switch off this this value, what will happen to our project. So we just switch it off, then we go to the payback period and see how this switching off affects the financial efficiency. And this means that we are too optimistic with this for example, type of customer, and we should think about because if for example we won't get this amount of mileage by this price, we will go to losses. For example, we also can, without switching it completely off, we can decrease the amount of mileage done by this pricing. For example, we can say, let's say that we will do 50% of this mileage. So we have, for example, it will be 15% of mileage by this price without switching it off. So what will happen to the payback period? And we can quickly adjust the parameters of the revenues and see what will happen with financial efficiency. So or for example, we can go to we can adjust any other type of revenues. Also we can adjust, for example, the price. We can say that for example, we will take just 20% of this price, we will take 30% of mileage, but we will take not this price, but we will just take 20% of this price. What will happen to financial efficiency? So we go back to the diagram. Just wait a little bit and see how this affects. So we still see that this type of customer sufficiently affects our financial efficiency. So we have to pay attention to that. So if we're not sure about these numbers, we should rethink our business concept. The next parameter is a coefficient that we add to the mileage. So for example, we assume that our truck will make 25,000 miles per month. So here it is. And we can also adjust, for example, this parameter. For example, if we make not 25,000 miles, but we will make, for example, 80% of this value. So we can quickly create numerous amount of scenarios, playing with coefficients to see what will be the payback period if this or that happens to the business. So this will be scenario if we decrease the amount of miles that we make per month. Here we specify the mileage per month inside the typical year. If we have some seasonality in business, we can specify this seasonality inside this typical year. Here we will specify the year and the month when we start our operating activity, when we get the first revenue. And now this next block deals with is reaching the planned revenue that we specified above. So for example, if we specify this mileage, the problem is that we won't be able to get this maximum mileage right from the first month of our operating activity. We will achieve it step by step. And here we can specify that, for example, at the first month when we start operating activity, we will get only 2% of 25,000 miles. Then we will get 5% of mileage, then we get 7%, 9, 15. What is very convenient, for example, if we want to displace our project, for example, to December 2022, we just specify it here, then we move here, and now we can see how the diagram is placed to the right. So it's very easy to move your project inside the timeline. So for example, if you want to displace it on August, for example, we just do it like this. Just wait a little bit while Microsoft Excel recalculates. See that how Excel displaces our model. So now why we are talking about this block of inputs, because when we reach this mileage step by step, this creates operational losses during the first month of operating activity. So if we go further to, this is the cash flow statement. If we go to operating, the result from operating activity,
we will be able to see here the operational losses during 1, 2, 3, 4 months, the first 4 months of operating activity. And this is very important because adjusting this percentage, you will be able to see more accurately the real amount of financing that you need to start the business, because the amount of financing consists of this investment stage expenses and these expenses during the operating activity stage, plus these expenses when we pay leasing payments, interest payments, principal payments, and so on. So we have a sufficient amount of operating losses that are to be added to the total amount of financing that we need to start the business. For example, if we go up and specify, for example, the another values of reaching so let's create the scenario like this. Now we will go back to our cash flow statement. So after this adjustment, we can see only 1 month with operational losses, maybe a little bit here, a little bit more here, but still we can see a decrease of financing needed to start the business. And many entrepreneurs want to play with the speed of reaching the planned values in revenues, because they will be able to see more accurately real amount of financing which they need to start the business. So usually entrepreneurs create numerous scenarios of reaching these planned parameters, and they see the gap of pessimistic and optimistic amount of financing that they need to start the business. So this is very important block of inputs because this affects the amount of money you need to start the business. So we're moving forward, and here we have we specify the idea of our model is that our truck, when we buy it, it won't last forever. One day it will become an old truck and we will sell it because the expenses on services will grow, and we will have to sell it. And here we specify the mileage when we sell an old truck and buy a new one. So if you look more closely to the payback period, you see these moments. Here they are. These are the moments when we sell an old truck and buy a new one. So many entrepreneurs, when they calculate financial models, their truck lasts forever when they buy it. But in reality,
when this truck reaches this or that mileage, it is sold and we buy a new one. So here we specify the mileage when we buy a new one and sell an old one. Then we specify the price of a new truck. This is if we want to use a lease scheme, leasing scenario. We specify the down payment for the leasing deal. This is the leasing payment per month. This is the term of leasing contract. This is the price of an old truck when we sell it. So in this moment, for example, when we buy a new truck, we will later sell an old one. So we also have to specify the price for an old truck that we sell when we sell it. Then we specify the amount of months during which we will be able to sell an old truck. Then we specify the consumption of gasoline, how many gallons per mile we have at our truck. Then we specify the price of gasoline per gallon. So here we have the services. Here we have the mileage when this or that service occurs, and here we have the expenses that we have during these services. So at service 1, it occurs when the truck reaches 10,000 miles in its odometer, and the service will cost us $200, for example. So here we have the list of services. This is the mileage on odometer. This is the expenses on this or that service. So we marked 1 million miles, for example, on the odometer, and services and expenses. Also, we can look at two scenarios of operating. The first scenario is when we buy a truck using our own money. This is current scenario. Also, we can look, for example, at scenario when we have a leasing scheme, leasing contract. We can also change this value and see what will be the payback period, simple, discounted, if we use another type of financing, for example, when we don't take so much money from our pocket. So we can quickly adjust this scenario to see what will be the payback period and other financial efficiency parameters if we use own funds or leasing scheme, leasing scenario. So we can quickly use this to switch on and off area. So also when we operate our truck, we may have also some fixed costs. Here we have the block of inputs for fixed cost. Here is the typical year from January to December. And if we have some seasonal fixed costs, we may also specify them here. So for example, some of expenses may have they are constant from January to December. Some of them may occur only once a year, for example in May. Some of them may occur once in a quarter. Some of them may occur once a half year. So, but also they are constant, they're fixed costs. And here in this block of inputs, we specify these fixed costs for our truck. So after we are done with fixed costs, we specify the payroll rate for our drivers. Then we move to different types of direct costs. For example, here we have the list of direct costs. And then we specify the amount of direct costs per mile for this or that type of costs. So here are the names of direct costs, and here is the expense per mile to calculate us these direct costs. Then we move to investment plan. So we may also have some other investments, but the price of a new truck. And here in this block we can put these expenses. This block is absolutely automated, so here are the names of investment items. Here we specify what we invest in. Here we specify when we invest in and how much we invest in. For example, if we want to displace our project to the right, for example, this is the August, it is the month August 2022, it is the month when we start operating activity. If we want to displace our project from, for example, from August to September, this investment plan will displace automatically. We won't have to retype all this data. We will avoid making mistakes, because many entrepreneurs, when they create scenarios, they make mistakes, they forget to displace the inputs. So here we just have to here we see the September. Here inside cash flow statement we also see the September, so our revenue is displaced on September 2022, and all the investment stage here is displaced to the right. So this is the stage, investment expenses plus the cost of a new truck. So if we look here, so these expenses are here, and if we want to displace the project to August, back, so here we see August. Now we can see how these expenses, investment expenses, they've moved here a little bit earlier because we start from August, and the purchase of a new truck displaced on July before we start operating activity. So we don't have to retype a huge amount of data. We will avoid tons of mistakes. So then we can add, for example, a loan. If we want to buy the first truck using a loan, we just specify the year when we take a loan, month, amount of loan, interest rate, term of loan, grace period for principal payments, grace period for interests if there is any grace period. Then we specify the revenue tax, profit tax, payroll tax, asset tax, and then all this information goes to see the result from operating activity. Here it is. So we can see the revenues. We can see the revenues that which form from the revenues itself from the truck. Then we also sell an old truck. We can go to the future and see, for example, somewhere in October 2026 we'll be selling an old truck. It means that near this date we're going to buy a new one. Here it is. So our revenue consists of two parameters. Then we have detailed direct costs, which consists of truck services, gasoline, different other direct costs. So then we see, after cash flow statement, how much financing we need to start our story. Then we can see, if we go to the next spreadsheet, the total revenues, expenses. I already told you already during the whole timeline of the project. As usual, here we can see the simple and discounted payback period. So this is the moment when we start operating activity. Then here we sell an old truck and buy a new one. Here the same story. Then here we specify the discount rate. We can specify any discount rate that we want. And then what is interesting, we can play, for example, we'd like to see how stable our investment project is. For example, what will happen if the monthly mileage increases or decreases? So we can go here, we can go up, we can place equals, multiply it on the coefficient of sensitivity analysis, then we just fix it with dollar signs. Then we will extrapolate this formula to the whole of our typical year. So now we have our sensitivity analysis coefficient added. Then we go to the sensitivity analysis and we will press sense button. We will press sense button to see how what will happen to our project if the monthly mileage will increase or decrease with a step of 5%. For example, if we can also adjust the pace, so you can see how the pace is changing here. We'll just take a 5%. So now we just have to press the sense button to see what will happen with our financial efficiency parameters if we increase or decrease the monthly mileage of the truck. So let's see what it is. So now we can see how the increase or decrease in mileage affects the financial efficiency. For example, if the mileage decreases on 20%, we will get the negative net present value. So this is the food for thoughts, food for discussion, food for changing maybe the business concept. We can also create other scenarios for stress testing. For example, we can add this coefficient to another parameters. So we just take away this parameter from mileage. We just paste it as numbers. So we don't have this coefficient added to mileage anymore. We can add this coefficient, for example, to price of gasoline. So just we'll do this. We will multiply it here, press enter. So now we have our coefficient added. For example, we would like to see that we would like to adjust the step of changing the parameter is 10%. now we do the same. We just press the sense button and see how increase or decrease of gasoline expenses affects the financial efficiency. So now you can see that we can add this parameter of of stress testing, for example, to the truck price, down payment, any parameter of direct costs, service costs, fixed costs, investments, payroll, and so on. And you will be able quickly see the total financing needed, simple discounted payback period. So people who want to start the trucking business also always want to play with numerous amount of inputs to see the critical values of this or that parameters of expenses, critical values of revenues that make them feel alright. So, and in this video I try to show you what usually entrepreneurs want to play with, what parameters they want to play with, what scenarios they want to build, what input data affect this business. I hope that this video was useful for you. I will give the links of creation this model from scratch in the description of this video. If this video was valuable for you, you may give us a like, subscribe our channel, share this video with your friends. Also, you can order financial model from scratch for your unique business idea. We can help you with that. So see you next videos. Thank you and bye.